Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So, as I'm sure you don't need me to tell you, 2020 has been an absolutely crazy year. There's been a whole bunch of really bad things happening all around the world, but one of the really cool things that has happened is it's introduced a lot of people to the world of investing and personal finance. A lot of people have been getting really interested in how they can have a more secure kind of financial life, how they can get to a point of financial freedom and having lots more options much quicker than they may have been able to otherwise. So I want to talk through some beginner kind of tips for getting started with investing. I think a lot of people have seen some really popular stocks go up a lot this year, things like Tesla and Apple and Amazon and Microsoft, and that's fantastic. But I want to give a few tips that help to ensure people have consistent success over a long period of time, because that is really what's going to make a substantial difference to your financial life. So if you do find this video useful, I would definitely appreciate a like on it. It really does help me out a lot. But with all that said, let's get straight into the video. So firstly, I just want to get started by answering the question, which kind of gives a nice overlay to this whole discussion, which is why should we be investing in the first place? And long story short, if you're trying to save your way to retirement or financial freedom or whatever you want to call it, you're going to have a very long road ahead. Now, let's say just hypothetically, you're going to earn, say, $50,000 a year on average for the rest of your life. Hopefully you can, grow that over a period of time if you're just getting started working. But let's say you're earning $50,000 a year. You're going to work for 40 years. That means that over your lifetime, you will earn around $2 million pre-tax. Now, you're going to have to pay some tax on that. So let's drop it down to say 1.5 million. You're then going to have to live and pay your bills and so on. So let's say that you can save maybe 20% of your after-tax income, which would be well above actually the national average. So that takes you down to about $300,000 over that period of time. Interest rates are currently near zero. If you're lucky, you could maybe get 2% in a sort of term deposit or something like that. And 2% of 300,000 gives you about $6,000 to live on at the age of 65. Now, it doesn't take a rocket scientist to figure out that $6,000 a year is probably not going to be enough for most people. So we need to do something with this money that we earn in the meantime in order to grow it into much more than that $300,000 pie by the time you get to retirement age or whenever you want to stop working. And the main key to that is investing. If you look at the historical returns in the stock market, they look really strong. They're probably 8 to 9 to 10% a year over the last 50 to 100 years, depending on which kind of country's stock market that you look at. And that has the potential to propel that $300,000 that you save over time forward to a much, much larger amount, which allows you, frankly, to be able to live without working when you get to an older age. Okay, so this investing thing sounds great. We're gonna, potentially make sort of 7 to 10% a year. It's gonna grow that pool of money that we've saved over time into something much larger out into the future. So how do we get started and how do we actually do it? Well, firstly, I just want to talk through a couple of considerations that you should be thinking about before you put any money to work. So I think a lot of people have this temptation to just jump into the stock market. Other people, frankly, are the complete opposite and they're terrified and never put money into the stock market. But here's a few things that I would consider before putting any money to work and buying shares in companies. Now, the first thing to realize is that although the long run returns from stocks are really good, they are certainly volatile. Now, you won't get that 7 to 10% return every year. It's going to be lumpy. Some years will be up 20%, some years will be down 20%, or potentially even more kind of either side. It's going to be a very volatile kind of bumpy ride. So in order to capture that market rate of return over a long period of time, you have to think about this as a long-term investment. And that means that any money that you put into shares is money that you shouldn't need for an extended period of time. I often hear this quote that people say, you should never invest more than you're willing to lose. And frankly, I think that is the dumbest quote ever. The stock market is a fantastic tool to grow wealth over a long period of time, and we want to be putting a lot of money towards it over a long period of time, ideally. So, thinking about it as money that could potentially go to zero or that you could potentially lose, or you kind of just putting it there because you can afford to lose it, I think is a ridiculous mindset. Now, I want to rephrase that quote a little bit, and I'm going to say that you shouldn't be putting any money into the stock market that you need within the next 3 to 5 years at a minimum. Now, the stock market is bumpy. Ideally, we want to lock that money up in stocks over a long period of time and have it compound away. but at some point you are going to need that money. And I think if you need that money at sometime in the next 3 to 5 years to buy a house or whatever it might be, it's probably not perfect to put into the stock market. There is a chance that, you could put $1,000 in and in 3 to 5 years it's only worth $800 because we've had some sort of stock market crash. But we know that over the long term, stocks do really well. If we look back to something like the 2008 financial crisis, one of the largest crashes in the past 20 years, we saw about a 40% decline, but that came back within sort of 2 or 3 years. So even if you do happen to capture one of those big crashes, there is a good chance that if you continue to hold those shares over a long period of time and continue to invest consistently, you're still going to make good returns over a long period of time. And the subsequent decades since that crash, the stock market is up very considerably since that point, and you would have more than recovered from the 2007, 2008 highs before the crash by the time you look at your stock market accounts today, 10 years later. So we're not going to use money that we need within the next 3 to 5 years. The other thing I would consider is that I would get rid of any high interest debt that you have. Now, I've just mentioned that we're going to get pretty lumpy returns in stocks most likely, but we're probably going to get high single digit returns. At least that's what the long term kind of data suggests that we might get. So if you've got high interest debt, maybe you've got a credit card or you've got hire purchases or you've got some other kind of debt where you're paying 15 or 20% interest because it's really short-term money that you've just put on a credit card on a spending spree or something, you're not going to be able to get that same sort of return in stocks. Now, if you have $1,000 in credit card debt and you're paying 20% a year on that, and then you put $1,000 into stocks and you're making 8% a year on that, you would have been much better just putting that $1,000 towards paying off your credit card debt. The way to think about that is that if you can pay off that money, that is an instant 20% per year return. So the first thing I would do before you even think about putting money into stocks in general is get rid of any of that high interest debt. Your mortgage is an entirely different conversation, I think. Often people have that locked in for a period of years at a low interest rate, which is, substantially lower than what you can potentially earn in stocks. That's a personal decision, but certainly the high interest consumer debt needs to go. Okay, now next let's talk about actually investing and where you should potentially be thinking about putting your money towards. Now, remember, I'm no financial advisor, I'm just a dude on the internet, so don't take this as personal financial advice, but this is my opinion and kind of the way that I think about it. So in my mind, you've got basically two different options in terms of where you put money, where you allocate it when you're first investing. Now, the first option and the direction that most sort of financial advisor type people will push you towards is to invest in a diversified basket of shares of different companies, maybe across different industries, potentially even across different countries, just giving yourself broad exposure to the stock market in general and trying to capture that long-term average, 7 to 10% return per year. And there's several vehicles now available to do that. So you've got things called ETFs or exchange traded funds. Basically, they allow you to achieve this goal really simply. Let's take, for example, an S&P 500 index fund. Now, the S&P 500 is 500 of the largest US companies that are publicly listed, and you can actually buy into a US 500 ETF, and when you buy that, one ETF, you're only buying shares in kind of the one thing, that instantly spreads you automatically across those 500 companies. So that's a really simple way to diversify. It's got really low fees, and that's a way that you're going to be able to essentially guarantee market rates of return. And aside from the financial benefits of, being able to instantly diversify and that sort of thing, it's going to take up a lot less brain power than the other strategy I'm just about to start talking about. It's going to be really simple. You can contribute to it consistently over a long period of time, and you're guaranteed to do the market rate of return. You're not going to get sucked into bubbles where there's a lot of hype, or you're not going to go into companies that are going to go to zero because they've got a lot of debt. Although that may be included somewhere in those 500 companies, averaged out, you're going to buy high quality businesses, large US companies or New Zealand companies or Australian companies, whatever country you kind of pick. You're going to accumulate ownership in those businesses over a period of time, and assuming that those economies and those stock markets grow out into the future, you're going to do okay. So that's option one. Now, what is option two? Well, option two is basically going down the path of picking individual companies. Now, this certainly is something that people have got really easy access to now. Pretty much every broker, you can go out and pick any sort of individual company that you want, whether it's New Zealand, Australia, the US, depending on kind of what broker you're with. But in my mind, you have to have a strategy if you want to go down this path. Now, the research suggests that the vast majority of people that try to pick individual companies underperform the market over a long period of time, with a few exceptions. So I think it is important to have a good long-term strategy if you are interested in going down this path. And from my perspective, it basically all comes down to this. Now, when you buy into shares in a company, you are buying ownership in the business. So if you're interested in going down the path of buying shares in individual businesses, you have to think of it just like you might go and buy a private business or go and buy a rental property, and really have a good understanding of what the prospects are for that company moving forward, how much cash you think that business can generate, and what price you're paying relative to that amount of cash that will be distributed over time. And certainly it can be a really lucrative strategy. Some people have done incredibly well, right up the top end of the bell curve. You've got the Warren Buffetts of the world, who've become the second or third richest person in the world, I think, at this point, from basically starting at zero, not getting any inheritance, just kind of compounding year after year after year after year by picking individual companies. Now, down the other end of the bell curve are all the people that you never hear of, all the people that have tried to pick individual companies, have got sucked into bubbles, or have invested in high-risk businesses with a whole lot of debt and have gone to zero. So there's people at both ends of the spectrum, and you need to consider certainly the risks. If you go down the track of picking individual companies, there's no guarantee now that you're going to get that market rate of return. You may do better, you may do worse, but you certainly need a strategy, and that's something that I talk about on the channel here all the time. But picking individual companies is really exciting. There's no way that you're going to get a quick 2 or 3 or 5 or 10x, over the next couple of years by investing in most ETFs. You're going to only really find that at individual companies, and it's really exciting. So if that's something you're interested in learning more about, frankly, I would probably stick to the ETFs as a starting point. That's the way I started out. And then as you start to understand how to analyze businesses and so on, that's something that you can grow into over a period of time. So that's all from me today. I do hope that was useful in terms of helping you understand how to get started investing in the stock market. Just to recap very quickly, only invest money that you don't need for the next 3 to 5 years at a minimum. Look at your options, either investing in ETFs and capturing a market rate of return, or potentially picking individual companies, and just frankly get started investing. Investing works over a long period of time. It will grow your wealth considerably, and it's something that is essential for most people in order to reach some point of financial freedom. So I do hope you enjoyed the video. If you did, please hit like, hit subscribe, and I will see you in the next one. Cheers.